Well, it's an honor and a pleasure to be here. It's been a great day and a half talking to a lot of you. So I'm also going to take my suggested task to step back from the individual papers and slides and so on to give a more general discussion about the area. And I'm going to talk about some of the challenges that confront macro models of financial frictions. I'm going to start with one view. It's not quite the truth, but it's useful for my purposes. Every major recession is preceded by, typically it's along with, but let's take preceded by for now. Um, and it's natural to suspect that the financial factors led to the recession. And Tobin, in his critique of Friedman Schwartz, uh, one part of it was called post hoc ergo propter hoc. After that, so therefore because of that, said, no, the first place you'd expect disturbances to occur, even if all the disturbances are on the real side, is in financial markets, because financial markets are going to anticipate all the stuff that's going to happen. And that poses a serious challenge for those of us like me who think that financial frictions and financial factors are important. How do you sort this out? The macro approach to solving this problem is to build a structural macroeconomic model to discipline parameters with key observations. These include second moments and the like about a variety of variables, financial and real variables, and a bunch of micro variables. And then, why do we want this model? Well, one important reason we want this model is to evaluate alternative policies and to think about this. And Mark, in particular, has been a leader in applying this approach to financial frictions models. The work he did with Ben and others on the financial accelerator mechanism has been extraordinarily helpful. So Mark's been a huge positive force in this area, pushing us towards writing down structural, quantitative models so that we can stop chitter-chattering about various kinds of possible channels and instead get a quantitative assessment of where we ought to go. So here's a popular view of business cycles, which the financial accelerator mechanism tries to explain. The basic idea is that investment is in some fashion affected by net worth. Some shock hits. Irving Fisher talked about unexpected deflation. It could be some sort of a bank run, multiple equilibrium, some sunspot, some shock or the other. This shock leads to reduction in net worth. That reduction in net worth leads to reduction in investment, and aggregate output falls. So this is kind of a standard kind of channel that lots of people have talked about. And the key ingredient in the models that generates all of these things is that the typical firm needs external funds to finance investments. Some agency costs induce a wedge between internal and external funds. There are binding collateral constraints, and the fluctuations in the wedge or the constraint affect investment in a big way. So let me start with the aggregate data, talk about challenges to simple-minded applications of this view. So here's one popular view. It's not there in a lot of the models, but one popular view that's there in ordinary conversation, which is, well, what are financial markets about? They're pipes that connect households and non-financial firms. I think about these as pipes. And what's a financial disturbance, if you will? These pipes get clogged. This cash flowing this way, the pipe gets clogged, cash doesn't get there, firms don't get the financing. What's the problem? The problem is that in the data, for the aggregate now, and we'll talk about individual things, it goes exactly the wrong way. Cash flows from firms to households. So yeah, pipes get clogged, so what? What's the big deal? So let me show you the sense in which this is true. So I'm going to ask this conceptual question by asking, can firms, how much of their investment can firms finance without external funds? Let me start by using data from the flow of funds for all non-financial corporations. It's purely a flow measure. So how am I going to construct this? Conceptually, all I'm doing is I'm taking the revenues of a typical firm, revenues from selling widgets. It pays its workers, it pays other businesses, it pays interest payments that it's got to obligated to make, pays taxes, also obligated to make. So that's an object that I'm going to call available funds from capital flows. This is a flow measure. So every quarter, I can tell how many dollars at the end of the quarter they have. I'm going to measure gross investment by capital expenditures. Notice that my notion of available funds says nothing about the existing stock of financial assets. It's purely a flow measure. That's the amount of dollars they got from operations that's available. Now, here's a graph from the flow of funds going back to 1946. So what are these figures? The blue line is my measure of available funds. I've scaled it by non-financial corporate GDP. And the red line is capital expenditures, my measure of gross investment, right? What do I want you to get out of this figure? So this is quarterly data going back, 60 years. Couple of things. One is the average gap between the blue line and the red line is large. These are not small numbers. This is 4% of value added by the non-financial corporate sector. The second observation that I want you to keep in mind is that with the exception of 4 quarters, in what is this, about 250 quarters, the blue line is always above the red line. So in the data, stuff flows from there, that's the funds that firms generate, to there. How does that stuff flow? In the form of dividends, cash dividends, stock buybacks, acquisition of net financial assets from households. In a variety of different ways, funds flow from non-financial firms to households. So the answer is no. And what's the punchline? Even in a deep recession, if all firms collectively just cut back on dividends, or alternatively stopped accumulating financial investments, they can comfortably finance all their investment internally, and the financial markets are not needed. Now, how do the models work? In the models, Mark talked about this, the internal rate of return is substantially greater than the external cost of capital. The firms are typically desperate for external funding because they need it. They've got these gorgeous, profitable projects. Just give me the money, and I can make a ton of money for you. The firms in the models jealously guard internal funds, and in the models, so this is a feature of the models, managers of firms with profitable projects never pay dividends, never accumulate financial assets, because they've got all these great profitable projects. Dividends are zero for all constrained firms. What does the data look like? Managers apparently, in the aggregate, have excess funds from operations to pay dividends, accumulate financial assets. In the aggregate, firms don't seem to be constrained. How about disaggregated data? So I'm going to do two kinds of disaggregated data. One question I'm going to ask is, I'm going to ask if across size classes, and I'll tell you why I use size classes in a minute, is there significant, some size classes are generating lots of available funds relative to investment, whereas other size classes are absorbing funds from the outside. Is there any huge heterogeneity? The main reason I use the size class is this data is available from the IRS, from corporate income tax returns, again, for all non-financial corporations. Again, you can break this up by size class, and I'm going to ask whether each size class can collectively, within that size class, fund its investment internally. Okay, so I'm giving you an illustrative picture. I have this stuff for every size class. I'm just going to give you 4 size classes, million to 5 million, and then on 250 million above. What do you want? What do I want you to get out of this picture? Within every size class, the blue line, which is available funds, substantially exceeds the red line. And so there's no funds flowing across any of these size classes. So At this point, you should be getting a little bit depressed, saying Chari must think that there's absolutely no role for financial frictions. And since we saw data from Ben today, we saw a bunch of data yesterday, we've got this huge, and Jeremy talked about a bunch of this data, we've got all this collective data from a variety of different sources saying financial factors are important. Carmen and Ken Rogoff talked about this. So, don't tell me that financial frictions don't play a role. In fact, I'm going to argue there is hope, but I want to suggest that the data points us in a slightly different direction in how to think about these financial frictions. So one possibility is these pipes. I think about these pipes not so much as connecting all non-financial firms with households, but rather as a key mechanism for, at the end of the day, taking money from cash-rich, project-poor firms, funneling them to cash-poor, project-rich firms. They may do it by going through households, the rest of the world, some complicated channel, but at the end of the day, the stuff is flowing from here to here, but in the aggregate, the stuff is flowing from all of those guys to these guys. So I'm going to ask the following conceptual question. How much would aggregate investment fall if no firm can invest more than its available funds? All right, so you can invest either if your investment is below available funds, you invest that. If it's above, just reduce it to that. So I can compute the same notion of available funds for each firm. I can compute gross investment, and I can compute the following two statistics. The first statistic is the use of external funds. So I ask, how much external funds are these guys using above their available funds, conditional for those firms that are investing more than available funds. And so this asks the following question. It tells you how much investment would fall if all of these guys were constrained to invest only available funds. An alternative measure, which is much more relevant to the class of financial frictions models that have been widely developed by, say, Cristiano Moto Rostagno, by Gertler Kiyotaki, by many others, is to ask, let me look in the data and let me describe as constrained those firms which are paying cash dividends of zero. So I could adopt an even more stringent criterion, but I'm just going to look at firms that are paying cash dividends of zero. How much would investment fall? And the reason for doing this is because in the models, the prototypical firm that uses external funds pays zero dividends. So the answer is that if all firms lose access to external funds, investment would fall by about 30%. So this is the hope for models of financial frictions. You can have an effect. This is the disappointment for existing models of financial frictions. This is a much smaller number. I'm not talking about output, remember. I'm just talking about investment. And it's an exceptionally extreme exercise. So the blue line tells me my first measure, which is the amount of external funds that's used by firms in order to finance their investment. And I thought it's kind of interesting that in the period from just before the crisis, it got as high as 60%. Right? They're using a lot. There's lots of churning going on. In the aggregate, funds are flowing from non-financial firms to households, but there's lots of churning within them. But this number is pretty darn tiny. So it poses a challenge. So that's sort of what the answer is. One promising thing, Zingales suggested this, so I'm very grateful to him. So a couple of people, Ali Sheridan and Ariel Zetlin-Jones, pursued this. It turns out that in the data, publicly held firms finance a lot of their investment internally, but at least in the Amadeus data for European firms, only about 10% of investment is financed internally, about 90% of investment is financed externally. And so this reallocation channel is promising for privately held firms. And why might it work? Because you could think about a situation where financial frictions affect privately held firms. There's one important distinction between privately held firms and publicly held firms, which is with a publicly held firm, if I altered my dividends, because shareholders hold diversified portfolios, doesn't affect the consumption of any individual shareholder. If I'm a privately held firm and I change my dividends, I eat less. Um, and so that's promising for these guys. The challenge, now there's a different challenge, is in the data, large firms also decline following financial crises. They also are affected. So you need some spillover mechanism from this guy to that guy. And Ali Sheridan and Ariel Zetland-Jones explore a bunch of possibilities. There are others that they don't explore. You could think about input-output structures, working capital, a wide variety of other possibilities. One interesting possibility goes back to work that Mike Woodford and Julio Rodenberg did is, and Solona Rodenberg, is that markups we know go up in recessions. It's possible that reduced competition from smaller firms spills over to raise markups. So there are a variety of possibilities worth exploring. I'm almost out of time, but let me just say a couple of things. One, the obvious thing that comes to many people's minds is, oh, some signaling story. That's why firms are unwilling to cut dividends. Part of the problem is that we're talking about responses to aggregate shocks, not idiosyncratic shocks. And let me describe this in an extreme way. In the middle of a recession, a manager with tons and tons of profitable projects who cannot give the following speech to his shareholders, convincing speech, should be fired. A speech that says, look, I'm laying off a whole bunch of my workforce. I'm closing plants, all because I got to pay you guys a bunch of dividends. I've got these phenomenally profitable projects which are going to pay you, the shareholders, off in the future, dramatically higher returns. Please let me cut the dividends so that I can get you those returns. If you can't make that convincing speech, what the hell job are you doing? So the usual response is, you shouldn't really take these constraints too seriously. All our models have frictions which are metaphors, stand-ins for some other story. You know, I write models too, quantitative models, so I take the metaphor idea seriously. Not everything is meant to capture exactly that. But this seems to me at the heart of these kinds of models. And for us to duck this, continue to duck this, is being a little bit irresponsible. So I've got a bunch of other stuff, including issues about bank special, but I'm essentially out of time. We'll talk about that later. So let me sum up. As a profession, I think we've made phenomenal progress in developing quantitative models of financial frictions. It's the only way to go. It's the only game in town. I don't think there's any other game worth playing. And the move towards serious quantitative models, look, what else are you going to do? You know, otherwise, we might as well all go home, retire, or something like that. And, oops, there's a typo here. This is a personal opinion based on my summary of the little piece of data. So it does not have to be something everybody agrees on. That financial factors and frictions are undeniably important. Spillovers, input-output structures, working capital, these kinds of channels, I think, are worth pursuing. I'm not sure that the collateral constraint channel applied to the representative publicly held firm is a promising channel to pursue, because these frictions still look like metaphors for some unmodeled stories. When the metaphors conflict so much with the data at such a fundamental level, I think it's time to model the unmodeled stories or to change horses. Thank you.
Thanks a lot. So let's take questions. I'm wondering whether Mark wants to answer Chari on the empirical evidence.
Let me first thank him. I mean, Chari's main complaint, or maybe one of his main complaints, is that we didn't take...
The microphone. Yeah. Yeah.
Can you hear it?
Yeah.
Okay. One of the main complaints is that we didn't allow for heterogeneity. In fact, in the handbook paper that Nobo and I did, we introduced a heterogeneity that's very close to the kind that Chari's been talking about. It's not exactly, would require some modification, but it's straightforward modification. We had sectors which had randomly varying investment opportunities. In fact, what will happen is exactly what Chari is talking about, that is, funds flow from firms without opportunities to firms with opportunities. So in fact, you copy you capture exactly the kind of heterogeneity he was talking about, and I expect that we'll be able to capture some of the data he's talking about. But just to be clear, we found that this is a lot of extra machinery, and it doesn't add much, at least we found in our cases, to what the macro dynamics are. So that's why we wrote down the simpler model. And we wrote down the simpler model also as we have a very complex financial system. So the challenge in this kind of modeling is to not have everything be a complete mess. There are some interesting papers that do have this firm heterogeneity, but they have very simple financial sectors, and in those models, a crisis is an exogenous change in a collateral parameter, and we need to go beyond that as well. So there's a kind of delicate balancing act. Now, I do have some issues with the data, and we can go into it another time, but the general point is I don't think you can aggregate across any category because there's a lot of individual heterogeneity, and so I think it's misleading to do so. And I agree that we don't have a good theory as to why dividends are costly to cut, but just because we don't have a good theory, we can't just rule out of hand that they don't do it, or they treat it as available funds. Yeah.
Ricardo, then Luigi, and then Doug, and Daryl. Yeah.
Working? Yeah, it's working.
I hope.
So let me also react to Chari's comment. Yesterday, when I presented this sort of risk-centric view, I had this balance in the risk markets, and that affected the goods market. But it can affect it through two ways. One is sort of pretty standard and traditional, which is financial frictions is on the supply side of the economy. But another very natural way is the demand side of the economy. And I think that the facts here fit very naturally with the demand side of the model. There's an increasing risk premium. Something has to give, prices decline, that produces a net worth effect, investment falls for traditional Q theory and so on. So you can do this even in a complete markets environment. So financial factors can matter even without financial frictions. Now, you add financial frictions on top of that and you add extra kicks, but if it comes from the demand side, it's totally consistent with that evidence.
Luigi.
I'm a little bit puzzled by Mark's model because he has this rollover whisk, which is a situation in which firms are solvent because the value of their liability is less than the long-term value of the asset, otherwise they wouldn't be operating. But then the value of their liabilities can be superior to the short-term value, the fire sale value of the asset. Now, if only one firm does this, then you don't have a crisis. If everybody is in that situation, a large fraction of the situation, that's exactly what the lender of last resort role of the central bank is about. So you should use Federal Reserve 13.3 under unusual and exigent circumstances. You extend, and the Fed will not take any risk. The Fed will not take any risk, and so the problem is solved. So it seems like Mark is blaming Ben for the crisis in his model, which seems crazy to me.
Well, no. I mean, come on. There's haziness. There's haziness in the world. That you don't, we can layer that onto the model. I'm just trying to identify the mechanisms. You could imagine layering a cloud of uncertainty so it's not so easy to tell what's going on. I mean, there's other possible, shocks that could be driving things on. So in real time, it may be tough to see what's going on.
There is lots of interest, so let's collect some questions, and then Doug, please.
Question for Jeremy. I understood your point in the past about the government issuing lots of debt sort of to get short rates up so the private sector wouldn't compete and sort of borrow short, lend long. And yet with this thing on how the interest rate work, it sounds like that might be a trade-off against it, because when you raise interest rates, somehow it seems like that puts the banks more into wholesale funding markets, which could give them fragility. Is there sort of a trade-off between these two, or is there something that makes it all go the same direction?
Should I try to answer that now, or should I wait?
Let's collect,
Okay.
because I see lots of hands. Darren.
Another one for Jeremy. On your garden variety day-to-day bank that's relying, and I think you're right, for franchise value on sleepy depositors. Looking ahead even 5 years, they'll all have an app on their iPhones that will be moving their transactional deposits to whichever banks, and they'll leave, the software will undo that for them. how are they going to maintain their franchise values? And if they can't do it that way, what will they do? Or what will happen in the I/O of banking?
So Raghu?
So we've heard the word beliefs a few times, and I wonder why we need to go to beliefs. It's interesting in its own right, but it seems as if we need to go to beliefs to explain bad outcomes, to distorted beliefs to explain bad outcomes. But you could explain bad outcomes through leverage. Leverage is set, anticipating a range of outcomes in the future. It's the best outcomes which drive the level of leverage. And so if bad outcomes happen, well, you're over-levered, you have all the consequences of leverage. So what leverage does is it unites future outcomes in some sense. And to that extent, you don't need to have a strong belief that the bad state will not happen in order to justify the bad outcomes. It can be just because you took on a lot of leverage, anticipating good outcomes.
Martin.
I'm responding to Mark's mention of Commerzbank, which made me aware of the fact that much of the framework of the analysis is really in a closed economy. And I'm wondering whether that's appropriate, given that, first of all, much of the buildup was of risks involved capital flows from both China and Europe, in particular Germany, into the US. And then if we think about transmission mechanisms of the crisis, a major role was played by the breakdown in international trade, a significant part of which was due to a breakdown in payment systems for very large transactions. Things like letter of credit did not work anymore at a time when banks didn't trust each other. In the case of Germany, I've been told that that had been the immediate impact of sort of on the real economy, far outside any credit channel or anything like that, from the events of September 2008. But the general message is we should begin to think about crises of this sort, taking account of the international dimension.
So John?
So I want to expand a little on what Ricardo said and give Mark a chance to answer what must be the first annoying seminar question every time this comes up. Mark's first slide said assumption one, all financing goes through banks. Well, yeah, for small bank-dependent companies, but most GDP is not that way. Most GDP is not financed by loans on the book from banks. Mark's second assumption was that arbitrage implied expected return premiums are all zero unless there's something wrong with banks. Well, for 30 years, asset pricing has had risk premia that are high and variable in representative agent frictionless models. If you don't like, Mark put up the bond premium. If you don't like the bond premium, go to Vanguard.com and buy some corporate bonds. There's this vision that you and me are, in November 2008, are unchanged, wanted to make risky investments. Firms were unchanged. They wanted to borrow and invest in risky projects, and just the bank was closed. But that's not, in November 2008, you, me, family offices, sovereign wealth funds, and all our endowments were panicked and selling like crazy. Why? I don't know. I mean, behavioral, rational, we can argue, but it's not because of bank leverage. So I conclude that the bank channel is one little extra thing, a little, maybe a straw on a camel's back, but the vision that it's everything seems overstretched.
Martin?
I was actually just going to make a very small point with respect to Daryl, which is the banks have been consistently surprised at how slow retail deposits have been to move, say, for example, to Marcus or things like that. They're surprisingly sticky, but they also understand that this is an exceptionally low interest rate environment, and they don't have models to predict what the pass-through, if you like, is going to be. And so they're very leery right now of exactly this point.
So last question by Guido, and then okay. So short answers, Jeremy, and then Mark.
Okay, so so Daryl, this is a great question about what's going to happen to, and I've thought, I thought this is, really a huge issue. So it's not completely as obvious to me that they're going to lose their franchise. I think the nature, if they're going to preserve their franchise, it'll have to change. In other words, now a lot of it is around having branches. Like, this is great for my father because he likes to go to the bank with his check. You know, my kids have never been inside a bank branch. So, like, the current model is for sure not going to work. Does it mean that they'll not be able to get stickiness some other way through other services that they provide that sort of encourage some? I don't know. I just don't know. So, for example, people still like ATM networks and things like that. So that might create, and there may be some web or internet version of that. But it's got to be something that they're worrying about, because the current version, based on branches, will surely not work. Doug, you asked this sort of question about the crowding out. Let me try to separate two things. One is that for a given level of wholesale funding that the banks are doing, you would probably prefer they do it, say, at the 6-month tenor than overnight. So that means if the yield curve is very steep at the front end, you might try to issue some more T-bills to kind of flatten that. Okay. A second point is, I think, a sort of logically distinct point, is in a rising rate environment, a larger fraction of their funding is likely to be wholesale, which may increase the urgency of doing the first thing. So there's always some logic for sort of trying to have the yield curve be flat, but it's probably more important when it's flat at 5% than when it's flat around 0. So I think that's the...
Mark?
Just briefly to John, perhaps I didn't make clear in the presentation, in the model, not all credit is going through banks. There's also open market credit as well, at least half open market credit. And the idea is that, just as in the data, the dislocation caused a huge increase in spreads. That's the story.
So thanks a lot for everybody, and let's continue the lively discussion over coffee.